How well did a firm perform during a period? In this video, I introduce the income statement, also known as the statement of earnings, statement of operations, or profit and loss statement, and explain its main components. Let's talk about the income statement. Income statement has a couple of names. The most common one today is probably the income statement, but you could definitely find examples where companies refer to it as the statement of earnings or statement of operations. Typically, for smaller firms, we can see the words profit and loss statement. We don't see it as much in big publicly traded company. But again, all of those are equivalent synonyms, so we don't want to read anything into the title. It's just a different way to name the income statement. So what does the income statement tell us? It tells us the revenues and expenses of a firm for a given fiscal period, either a year or a quarter. It also tells us the gains and losses, and we're going to learn the difference between those and revenues and expenses. Fundamentally, the income statement answers the question how well a firm performed during the period. So again, notice that this is a different question than how is its financial position right now? That was a balance sheet question. The balance sheet question tells us about what do we have in our possession in terms of the assets, what do we have as obligation in terms of the liabilities, as a snapshot. The income statement instead says, I'm going to look over the prior quarter or year, and I'm going to ask about how I'm performing. Am I able to generate sales to my customers? Am I able to control my costs in terms of expenses? Am I net profitable or am I unprofitable? The fundamental equation is that revenues minus expenses plus gains minus losses equals income. It doesn't quite have the same ring as the balance sheet equation, assets equal liabilities plus equity, but that essentially is what the income statement captures. Notice what is missing from these discussions. There is no mention of cash. The income statement does not tell us about the cash inflows or the cash outflows. We're going to stress repeatedly that the income statement tells us about the effects of the economic transactions and events, regardless of when the associated exchange of cash occurs. We're going to see example where something can show up on the income statement before the cash changes hands, and something can show up on the income statement after the cash changes hands. Both of those are possibilities, but the income statement is really interested in kind of the true timing of when the events occur. So just as a refresher, let's remind ourselves that the income statement is a tie that is going to help make sure that we understand how the balance sheets have morphed over time. For the balance sheet, we only see a snapshot, how the assets, liabilities, and equity looked last year versus this year. And the income statement is one of the three statements that helps to tie it out and tells us what are the transactions that happened during the period that explain how our position have changed from period to period. This is a very simple hypothetical income statement. It has the title of the company. We sell everything. It has the label, the fact that it's an income statement, and it has the date that this is for the fiscal year ended June 30th, 2008. So it tells us the length of the period over which we're looking at these transactions. This is kind of the typical structure of the income statement. At first, we will have the revenues, which are the sales of a company, and then we will have the expenses. And in this example, the company has revenues that are bigger than the expenses, so they are profitable. So they have net income on the bottom. But of course, this is not a very realistic income statement. We're going to see at some real ones which have a lot more categories. But to start with, let's make sure we understand our definition. So what are revenues and what are expenses? Revenues are increases in net assets from delivering goods or services that constitute the firm's ongoing primary operations. Revenues intuitively should be clear. Revenues are just your sales. But there's two nuances here. First of all, these ongoing primary operations. So sometimes firms have transactions which are not in their main line of business. For example, let's suppose we have a firm who is a retail firm, and this firm has a property like a building, that they no longer need, so they decide to sell it. And maybe they sell it advantageously. Maybe they have a kind of nice gain that they can recognize on that sale. Can they record the sale of that property as revenue? They cannot, because they're not a real estate firm. Their job is to sell clothing. That is their primary line of business. So any other transaction, even if it is kind of advantageous to them, cannot be recorded as revenue because it is not their primary line of business. And companies have a lot of these kind of peripheral additional transactions, and they cannot be recognized as revenue because revenue is reserved for whatever it is that your main line of business, your relationship with your customers, that's what it captures. Point number 2 is I have an asterisk here for net assets. Again, notice this doesn't say revenue is an increase in cash, because sales are not always going to be immediately paid for in cash. Sometimes sales are never going to be paid for in cash. Sometimes there are transactions where it's an exchange of assets that's not cash. So it's important for us to understand that revenues lead to an increase in net assets. Maybe cash is going up, maybe account receivable is going up, or maybe this customer already prepaid us and we have a liability called deferred revenue, which I introduced in the balance sheet lecture, and that liability is going down. So let's talk about the word net. We're going to see the word net a lot in the context of financial reporting. This is not some magic word. The word net literally just means something minus something else. It's just the difference between two amounts. For example, net assets just means assets minus liability. So when we define revenue as increases in net assets, that means either some kind of an asset is going up or some kind of a liability is going down. We're going to see other example of net amounts in the future. We have net accounts receivable. We have net PP&E, net revenue. In all of those situations, net has a specific meaning. In that context, it means something adjusted for something else or something minus something else. So again, what net means really depends on the word that comes after it. Net assets means assets minus liabilities. That's all. So expenses are decreases in net assets from activities that support the delivery of goods or services. Again, we're talking about the company's primary line of business. In order to generate revenues, they need to engage in some typical activity. So if you're manufacturing firms, in order to generate revenue, you have to buy raw materials, you have to pay your workers. All of those things constitutes your primary line of business. Again, this is expenses, not necessarily a decrease in cash. It could be a decrease in another asset. Okay, it's something else that you're using up, or it could be an increase in a liability. Salary payable, your workers work for you, you haven't paid them yet, but you will in the future. It's an increase in a liability, which is a decrease in net assets. So we're going to see all of these situations. Now, let's talk about these peripheral transactions. A lot of companies will have transactions that are not part of their primary line of business. They have to maybe buy and sell secondary assets because they no longer need them. Maybe they extinguish some debt again. And these things might lead to a gain or loss that is recognized on the income statement, but it doesn't get lumped together into revenues and expenses. We call these gains and losses, and we highlight them separately on the income statement. Why do we separate revenues and expenses from gains and losses? Because the users of the financial statements probably want to understand which items are likely to repeat over and over. So transactions with customers, you expect them to be continuous multiple periods, and which items are kind of stemming from one-off transactions, less relevant, less tied to the fundamental nature of the company. So again, these are net assets changes relating to potentially both changes in assets and changes in liability that stem from these incidental additional transactions. Let's introduce the definitions of some of the most common types of expenses. So these are not by far all expenses that you can find if you go hunting through the 10Ks, but these are probably the most common ones. So the first one, and typically a very, very large one, is something called cost of goods sold. It's also known as COGS, cost of products, cost of sales. So there could be a couple of different language for it. If you're already noting a pattern in accounting, a lot of times we do have synonyms. So some firms and some industries kind of have a tendency to speak about the same item a little bit different. The more we get exposed to it, the more you see examples, the more we recognize when they refer to the same thing. So here, cost of goods sold, cost of product, the same thing. So these are the costs that are directly tied to the purchasing and production of inventory. If you're manufacturing firms, what are the things that you had to incur directly to produce inventory? You had to buy that inventory, you had to ship it to your warehouse, you had to pay the workers to work on it directly, you had to insure it while it was in your warehouse. All of those are directly tied to the inventory production. And importantly, let's look at the second part of the definition. So these are the direct costs tied to the purchasing or producing inventory that was sold to customers during the period. So this doesn't reflect the cash that you spend on buying inventory today. This says that the inventory that you sold this year, how much did that inventory cost you to get it ready to go into the customer? So it's kind of very tied. It says, of the sales that you recognize this year, what was the original cost of producing the inventory that allowed you to make the sales? If you're not a inventory firm, if you don't have physical goods, you still have the equivalent of COGS, except it's going to be cost of services. And again, so for a consulting firm, these are going to be the cost of how much do you owe to your workers associated with the revenues that they helped you to generate during this period. Now, in addition to the costs that can be directly tied to your revenues, you have supporting operating costs, a lot of those. Something called selling, general, and administrative, SG&A. There's a couple of different words for it. Maybe it's just general and administrative, that could also be used. But these are just the general operating costs of running your business. So the rent on your headquarters building, the salaries to your support staff and to your accounting department, all of these things, they're not directly tied to the production of revenues, but they're supporting activities. They're going to be included in these other catch-all category of general expenses. Research and development, if you're an R&D type firm, is going to be an expense. Marketing and advertising, if you are somebody for whom significant brand development and name recognition matters. Depreciation is a specific type of expense that we're going to learn about that reflects allocating the cost of buying long-term productive assets to multiple periods as we use them up. Interest expense, if you borrow money, then you have a cost of debt associated with that. That's going to be showing up on the income statement as well. And of course, taxes. Now, again, this is not an exhaustive list, but this is a list of the most common categories. One little side note is, again, a little bit about the language. The word provision, it crops up here and there. It's just a synonym for an expense in the US GAAP setting. And the reason I just want to stress it is because if you are not in the US GAAP setting, if you're in the international setting under IFRS, the word provision actually has a different meaning. So we want to be a little bit careful. A lot of the things that I cover in these videos, while they are rooted in US GAAP, they do have a high degree of carryover to the international standards and to the filings done under those standards. It is not always the case. So we want to be careful, and we want to make sure that we understand whether we're looking at a financial filing prepared according to US GAAP or another system. In this video, I'm going to take a look at Johnson & Johnson. This is the income statement. Notice that for Johnson & Johnson, they happen to call it a statement of earnings. What I'm going to point out in terms of the format of the income statement, first of all, notice that it has 3 columns instead of 2. So for the balance sheet, we only have prior years for comparability, because for the balance sheet, we only need 2 years. Balance sheet is a snapshot. So if we have last year's snapshot and this year's snapshot, that's kind of enough for us to understand how things are looking relatively, because each of these snapshots reflects everything that happened to the firm from the beginning of time up until today. So for the balance sheet, 2 years is enough. The income statement only gives us the results of the transactions and event that happened in one period. We require them to actually give us 3 years worth of data for us to be able to make comparisons and determination of how things are looking relative to history a little bit more. So here, Johnson & Johnson, this is for 2025, but they do give us 2024 and 2023. Again, we pay attention to the units, so we notice that this is in millions, except for per share that we're going to talk about later. What do we have? We have sales to customers as the first line item, and then we have a lot of items. In the balance sheet, we talked about the structure of the balance sheet being predictable in the order of liquidity within assets, liabilities. So what is the order of the income statement? This is the typical structure. The first item is always going to be sales. Sometimes it's going to be called revenues, sometimes it's going to be called sales, but that is the start of the income statement. We call these the top line because they're literally on the top line. Then we have our expenses. So the first general category are operating expenses. And the way that they're grouped here is how closely related to the generation of sales. So cost of products sold is the expense that's most closely related to the generation of sales. It receives this prime position on the top. And then we have selling, marketing, and administrative expense, which is the supporting operating expenses. And then we have R&D, research and development. Obviously, it's important to generate your sales, but it's kind of removed in timeline, right? The R&D that you do today will help you to generate sales in the future. It's not nearly as closely tied as the cost of actually stamping those pills and producing that baby wash. Then we have financing item. Here we have the interest expense as well as something called interest income. Why does Johnson & Johnson have interest income? Because they must have invested in some securities, debt and equity securities that are yielding them some positive return. Maybe this is debt securities that are yielding some interest earned, or equity securities that are receiving some dividends, something like that. Interest expense is obviously the cost of debt. We have transitory items. All of these are expected to recur. Transitory items are one-off items. So for example, restructuring, when you are laying off people, closing a division, kind of anything like that. Other events, which we don't know what these are from the income statement, but if we go to the footnotes, we can find out that maybe this is a lawsuit or this is a gain from a sale of a building or something like that. Again, something that's not expected to recur. So the way that we value it in terms of forecasting the future is definitely going to be different than the things that are on the top of the income statement. And typically, the last expense that we have in the income statement is your taxes. Here it's called provision for taxes on income. And that gets us to the bottom line, which is net earnings, also called net income. Here in the case of Johnson & Johnson, there's actually one more item here, which are discontinued operations. Again, kind of a little bit beyond our scope. This is a topic for a future video, but it has to do with a division that you're separating and spinning off. One thing that I want to highlight is that I want you to be careful in terms of positive and negative numbers. It seems like a kind of a silly comment, but it's definitely very important. Let's take a look at Johnson & Johnson's. First of all, notice that Johnson & Johnson shows all of their expenses as a positive number. Essentially, they have revenues as a positive number, and then expenses are also a positive number. So their net profit is the revenues minus these expenses. Okay, that's fine. This is just kind of a presentation choice that the expenses are shown as a positive number. Even though they are profit reducing, they're just kind of shown like that for simplicity to avoid, minus signs and parentheses. But notice that they do have several negative items on the income statement. For example, interest income is consistently negative, and this other line item is negative in one year and positive in other years. The fact that these things are negative tells us that these are actually profit increasing items. Because Johnson & Johnson has taken a position that they show their expenses as a positive number, anytime we see a negative number, it tells us that this is the opposite of an expense. This is a gain. This is a profit increasing number. That's how we interpret that. And in case we get confused, for the items that could be profit increasing or profit decreasing, they actually tell us how to read this line item. So this weird language, other parenthesis income, close parenthesis expense, means if you see a negative number in this line item, it is an income number, it is profit increasing. If you see a positive number in this line item, it is a profit decreasing, it's an expense. That's how we read this particular line item. And just to show you an example of a company that does it differently, let's go to Edgar and let me pull up Boeing. So if I go to Boeing, so I pulled up the name Boeing, I see that I got to the correct place. I'm going to go to the 10K. Their last 10K was filed on January 30th. So I'm going to load it. Again, we're getting more and more familiar. The structure of the 10K is the same. We're seeing the same table of content. We're going to go into item A, financial statements. We're going to go into statement of operations, which is what they call the income statement. And we see that their income statement, it starts with revenues, that's fine. But then notice how they present their expenses. Their cost of sales, which they call cost of products and cost of services separately, are shown as a negative number. Their research and development is shown as a negative number. So Boeing just does it flipped. They show all of their profit decreasing items as a negative number, and sometimes they have a positive number here because it is a profit increasing one, so other income. Don't read anything into it. This is just kind of a formatting choice. I will say that I think majority of the firms follow the same choice that Johnson & Johnson. Most firms that you're going to look up, they're going to show their expenses just as positive numbers, but you're definitely going to find example of firms, big and small, like Boeing, who do it a little bit differently. They do it flipped. Just be careful when you interpret it, and definitely if you're importing any data to something like a spreadsheet or to any software to do analysis, just make sure that you are very clear whether you're importing positive numbers or negative numbers, because it can lead to kind of a silly mistake. The other general warning I'm going to give here is that, again, we need to be careful with the language that we use very casually in our everyday life and the language that we use for financial reporting. Let's separate revenues from earnings and profit. A lot of times we see those items being commingled, and these are just screenshots from some websites. And again, things are changing over time, so these may have been fixed since the time that I grabbed them. But this was originally from dictionary, and it said, what is revenue? The definition says revenue is income. That's just wrong. I already told you, even if you don't know any other accounting, but revenue are sales. Now, income is what you have when you start with revenue and you subtract the expenses that you incurred to generate that revenue. So this is not a correct definition. Revenue is definitely not income. It is definitely not earnings or profit. There's some other words thrown in here, taking, receipts, proceeds, which are just not typically used in the financial reporting context. So I don't even know what to do with them. Same thing here. This is from Investopedia. Revenue is the gross proceeds collected by an entity. It's kind of in the right direction because it says it has to do with company's operation. But then it says it's the total money a company's earned. It veers into a combination of correct and incorrect definitions. Same thing, more and more, we're relying on AI. That is evolving all the time. This is a screenshot taken in not too distant past where AI was telling me that revenue is the total income generated by a business through its primary operation. So it's kind of almost there because it does have the word sales in there. So it's kind of getting there. But it certainly tends to commingle the words income and sales, which are definitely not synonyms. The only time they're synonyms is when you have sales and you have zero expenses. In that case, yes, your income is equal to your revenues, but real firms that doesn't have it. And the other thing I want to highlight here is that a lot of the times the language is much too casual about referring to cash collections and referring to economic events. And that's something we're going to see over and over. Revenue has to do with whether you did the work for your customers. It does not have to do necessarily with whether you have already collected the cash. So this is something that we need to mentally break that connection in our mind, is that the income statement reflects economic transactions. And then we are going to eventually introduce statement of cash flows that will deal with actual cash events. I told you that revenue and income are not the same thing. Well, how about income, earnings, and profit? Are those the same thing? Yes, they are. Those things you can use interchangeably. Profit, earnings, income, totally fine to use all of those when you refer to sales minus some expenses. But the question is, which expenses? all of them, some of them. Now we're getting into subtotals. The financial reporting is not regulated, so firms are going to differ in terms of whether they show us the subtotals or whether they don't, and we have to calculate them ourselves. But it is good for us to introduce them so that we're all on the same page in terms of what they mean. Here we have two companies. We have Home Depot and John Deere. And I literally copied the way that they present their income statement. So both of them start with revenues. Both of them show us the cost of sales. And then Home Depot calculates a subtotal called gross profit. Gross profit is just revenues minus cost of sales. Before you take into account any additional operating costs, what do you have as a profitability? If you only subtract the main cost that it took you to generate these sales, the cost of products. John Deere doesn't give us a gross profit, but if we wanted to, we absolutely know how to calculate it. It's just net revenues minus cost of sales. Then we have all of our operating expenses, SG&A, research and development, which obviously Home Depot doesn't have, but John Deere has. Depreciation and amortization, which Home Depot does show, John Deere doesn't. It probably just includes it in another line item, other operating expenses. And then Home Depot gives us another subtotal. It says, this is operating income. John Deere doesn't give us subtotal, but if we wanted to know the operating income before we get to the financing, before we get to taxes, we could definitely calculate it. We would know to stop at this point and do the calculation. Then we have financing, interest, and other expenses. Both of them give us a subtotal of pre-tax, so income before income taxes. We have the income tax expense, and of course, both of them give us the net earnings. Could be called net profit, net income, net earnings, but it is going to have that word net in there. There's definitely differences in terms of how much granularity the companies are going to show us, but the definition of those things are the same. They're generally understood by everyone. The final thing I'm going to say here is that I don't have them on the slide, but maybe you've heard the terms EBIT and EBITDA. EBIT is just earnings before interest and taxes. So for these companies, it would be the same thing as operating income, right? It would be earnings before I take into account the finance items, before I take into account the taxes. EBITDA is earnings before interest, taxes, depreciation, and amortization. So it would also strip this out. So companies do not show EBIT and EBITDA, but you could definitely, if you're interested in for your purposes, all valuation or anything like that, you can definitely do the calculation by kind of working your way from the bottom of the income statement up. Thank you for joining me in this introduction to the income statement. Make sure that you view it together with the introduction to the balance sheet and the overall discussion of the basic financial statements. The next video, Accruals and Deferrals, will be the last one of this first introductory batch of 4 videos, and it will really bring home the distinction between economic activity and the cash inflows and outflows timing of the company. So if you enjoyed this video, then please like, subscribe, and tell all of your colleagues and friends, and I'll see you in the next one.